Welcome to the Byte-Size Brief. Today, we are putting Vanguard S&P 500 ETF, VOO, that's VOO, completely under the microscope. Let's get into it.
I am very glad we're doing this today, honestly.
Right, because, you've probably been told your whole life that the absolute safest, most responsible place for your money is a broadly diversified index fund.
Exactly. The old reliable advice.
Yeah, just set it, forget it, and let the American economy do all the heavy lifting for you over the next 30 years.
That is the traditional wisdom, yes.
But what if I told you that the ultimate quote-unquote safe investment is quietly morphing into this highly concentrated trillion-dollar gamble on artificial intelligence?
Well, it is a critical question, and is exactly why we need to examine Vanguard S&P 500 ETF, specifically right now. I mean, we are sitting here in April of 2026, and the macroeconomic landscape has just shifted dramatically beneath our feet over the last few months.
It really has.
The ground rules of the market are changing, and the passive strategies that worked so brilliantly last year are suddenly under, well, immense pressure.
They are. I mean, 2025 was an absolute banner year for stocks. It felt like everyone's portfolio was just going up and to the right almost effortlessly.
It was a very comfortable year for retail investors.
Very comfortable. But 2026 has brought a completely different energy to the table. We are seeing severe market volatility. We've got these new heavy trade tariffs making daily headlines. And, there are some serious fundamental jitters in the tech sector right now.
There certainly are.
So the mission of our deep dive today is to objectively assess whether Vanguard S&P 500 ETF, VOO, remains the ultimate buy and chill retail investment. And we are going to use brand new Q1 2026 data, recent commentary from Vanguard's leadership, and Vanguard's own 2026 economic outlook to figure this out.
And to establish a baseline for this analysis, we really have to grasp the sheer scale of the asset we are talking about.
Right. It's not a small fund.
Not at all. We are looking at a fund currently sitting at a massive $904.79 billion market cap.
Wow. Wait, almost $1 trillion in one fund?
Almost $1 trillion. It is an absolute behemoth. To put that in perspective, that is roughly the gross domestic product of a mid-sized developed nation, just all sitting in one single equity vehicle.
That is just wild to think about.
It is. But the macroeconomic headwinds of early 2026 mean that investors can no longer just blindly throw money at the market and assume that massive scale equates to absolute safety.
Yeah, big doesn't always mean safe.
Exactly. You need to look very, very closely at the structural mechanics of what you are actually holding.
Because to understand where Vanguard S&P 500 ETF VOO is heading for the rest of 2026, we first need to look under the hood at what is driving it right now. Like, what is the actual engine of this ETF? Because I always assumed it was just this perfect, even slice of the American corporate pie.
Well, that is a very common misconception, and it brings us to the core issue here, which is extreme concentration risk.
Okay, unpack that for me.
So you see, Vanguard S&P 500 ETF, VOO, is a market cap-weighted index fund. That mechanism is absolutely crucial. It means the fund doesn't buy equal amounts of every company. It buys more of a company as that company becomes more valuable.
So it's kind of like a popularity contest with money.
Essentially, yes. It creates a momentum feedback loop. As a massive company's stock price goes up, the fund is mechanically forced to buy more of it, which then pushes the price up even further.
Wow. Okay.
Right now, because of that exact mechanism, the top 10 holdings make up a staggering 40.7% of the entire fund.
Wait. 40%?
40.7% to be exact. There are over 500 stocks in the portfolio, but just 10 of them control over 40% of your investment's daily movement.
That totally flips the script on what people think they own.
It really does.
I mean, if I order a balanced meal, I expect appropriate portions, But basically, buying Vanguard S&P 500 ETF, VOO, right now is kind of like buying an AI tech ETF with a side salad of the rest of the U.S. economy.
That is a perfect way to visualize it, actually. If we look at the sector breakdown, the information technology sector alone accounts for 34.4% of the fund.
That is massive for just one sector.
And it gets even more concentrated at the very top. Nvidia represents 7.8% of your total investment.
Almost 8% in one stock.
Apple is 6.9%, and Microsoft is 6.1%. You are incredibly exposed to the fortunes of a very small handful of tech giants.
I really want to push back on the traditional wisdom here because this feels like it goes against everything we are taught in Investing 101.
How so?
Well, we are relentlessly told to diversify to protect our downside, right? But if over 40% of our money is locked up in just 10 stocks, Is Vanguard S&P 500 ETF, VOO, still the safe broad market safety net it used to be? Or are we just riding a tech wave blindfolded?
That right there is the defining tension of this entire market right now.
Yeah.
The reason for this massive tech concentration is driven by a group of mega-cap companies that Vanguard has labeled the AI scalers.
AI scalers. Okay.
These are the tech titans that are currently committing a historic $2.1 trillion in capital investments by 2027.
2.1 trillion.
With a T.
With a T. And they aren't just buying software either. They are building hard, physical, artificial intelligence infrastructure.
Like data centers and stuff.
Exactly. We are talking about massive data centers, advanced semiconductors, and the dedicated energy grids required to power them all.
That is not just a big number. That is a world-altering amount of capital. It honestly reminds me a bit of the late 1990s during the dot-com boom.
Oh, that is a very apt comparison.
Right, because companies spent billions laying fiber optic cables across the oceans, convinced the internet would change the world. And they were right. The internet did change the world.
Yeah, absolutely did.
But the companies that laid the cable still went bankrupt because they built far more capacity than anyone could actually pay for at the time.
That is a highly relevant historical parallel. And it is exactly the risk scenario we are looking at today with AI.
And here is how that directly impacts the fund's mechanics. Vanguard S&P 500 ETF, VOO, has a beta of exactly 1.00.
Beta of 1?
Right, beta is simply a measure of relative volatility compared to the broader market. A beta of 1.00 means the fund has no brain, no active defense strategy, and literally no way to duck a punch.
That just takes the hit.
Exactly. It correlates perfectly mathematically to the S&P 500 index. So as these AI scalers exploded in valuation over the last couple of years, the ETF perfectly captured all of that AI exuberance.
Which is great on the way up.
Of course. It drove those massive portfolio gains everyone loved in 2024 and 2025. But because it is perfectly correlated, it must also bear the absolute full weight of any tech sector corrections.
So if tech falls, we all fall.
Exactly. If the AI scalers stumble, if that $2.1 trillion bet doesn't pay off immediately, the fund stumbles equally hard.
Okay, so compared to last quarter, what actually moved the needle here? Because we understand the structural risks of being top-heavy, but how is that playing out in the actual numbers as we navigate 2026?
Well, the contrast is quite jarring, to be honest.
Let's hear it.
If we look at the historical context, the recent past was incredibly strong. Q4 of 2025 closed out with a solid positive 2.65% return, wrapping up just a massive year.
Yeah, it was great.
In fact, the 12-month trailing return for Vanguard S&P 500 EPF, VOO, boasts an impressive 34.9% to 36.4%, depending on the exact tracking day you measure from. Investors felt completely invincible.
I mean, it's hard not to feel invincible when you are looking at a 35% return in a single year from a basic index fund. That is the kind of performance active hedge fund managers dream of.
Precisely. It was an anomaly. But the present reality is telling a much harsher story.
Right, the 2026 vibe shift.
The Q1 2026 data shows a stark reversal of that invincible trend. As of March 31st, 2026, the year-to-date return for Vanguard S&P 500 ETF, VOO, is roughly negative 4.72%.
Ouch, almost down 5% just to start the year.
Yes. Furthermore, the technical data shows the ETF is currently trapped in what analysts call volatility bands.
Volatility bands. Let's translate that out of chart jargon. Are we talking about like a ceiling and a floor for the stock price?
Exactly that. Think of volatility bands like the guardrails on a bowling lane. Right now, technical analysts see a hard floor of support at $637.40.
So that's where people step in and buy.
Right. That is the price where buyers historically step in to scoop up a perceived bargain. But then there is a hard ceiling of resistance up at $652.32, which is where sellers consistently take their profits.
Okay, I see.
And the mathematical models currently signal a 67% probability of range-bound trading.
Meaning there's a 2/3 chance the fund is just going to bounce back and forth between those two guardrails for the foreseeable future rather than throwing a strike and hitting new record highs.
That is exactly what it means. The upward momentum has stalled.
Hold on, how does that actually affect Vanguard S&P 500 ETF VOO's stock price for regular investors like me? What is the actual real-world trigger causing it to bounce off those guardrails instead of climbing?
It comes back to that lack of active defense mechanisms we discussed earlier with that 1.00 beta.
Right.
The negative 4.72% drop you're seeing on your brokerage app right now is a direct mechanical result of the fund absorbing recent macroeconomic shocks, without any shock absorbers.
Shocks like the new tariffs.
Specifically the tariffs. Yes. The market is reacting to escalating trade tariffs. We are looking at 25% tariffs on goods from Canada and Mexico and an additional 10% on China.
Right, and those tariffs hit the real economy hard. I mean, if a tech hardware company suddenly has to pay 10% more for components imported from overseas, their manufacturing costs just spike.
Exactly.
Their profit margins shrink, Wall Street lowers their earnings estimates, and their individual stock price drops.
Spot on. And because Vanguard S&P 500 ETF, VOO, is fully passively managed, there is no portfolio manager sitting at a desk at Vanguard actively deciding to sell those vulnerable tech stocks.
They can't just pivot to something safer.
No, they can't move your money into defensive utility companies or government bonds to protect your capital. The fund's legal charter requires it to hold the index, no matter what happens in the news.
So they just have to sit there and take the punch.
Yes, so when the broader market takes a collective hit due to these global supply chain fears, Vanguard S&P 500 ETF, VOO, mechanically eats that exact same decline. You own the whole market, which means you own the market's problems in real time.
Man, if the fund is taking these exact hits because it lacks shock absorbers, it really makes me wonder who is actually staying in the passenger seat right now.
It is an interesting behavioral question.
Because with the fund down almost 5% to start the year, and inflation and tariff headlines just dominating the news cycle, are retail investors finally abandoning ship? Are people panicking and selling their Vanguard S&P 500 ETF VO shares?
The behavioral data on this is genuinely fascinating. They absolutely are not selling.
Wait, really? Not at all.
Not at all. We have real-time metrics from Vanguard's head of investor behavior, Andy Reid, regarding this exact psychological phenomenon.
How's he seeing?
He noted that the overall emotional theme of the market has definitely shifted. 2024 was defined by what he called steady optimism. But 2025 and early 2026 are definitively characterized by rising anxiety. The retail base is nervous.
Which is completely understandable. I mean, when you are paying more at the grocery store due to inflation, and then you log into your brokerage app and see just a sea of red from these tech corrections, the instinct to hit the sell button is overwhelming.
It is a totally natural human reaction. But here's where the data defies expectations. Despite that rising anxiety, Vanguard's internal tracking shows that on any given day, a staggering 97 to 98% of Vanguard investors are making absolutely zero changes to their portfolios.
Seriously, 98% are doing nothing.
Nothing. They're just sitting on their hands enduring the volatility. Furthermore, social sentiment data from retail investor forums shows Vanguard S&P 500 ETF, VOO, scoring a highly positive 75 out of 100. The loyalty is ironclad.
That is the VOO and chill mantra fully weaponized.
It really is.
People really are just trusting the long-term process. And honestly, I think a huge part of that unwavering loyalty comes down to the underlying math of the fees.
The fee structure is critical, yes.
We have to look at the cost advantage. If we briefly benchmark it against a major competitor like the SPCR S&P 500 ETF Trust, commonly known as SPY, Vanguard S&P 500 ETF VOO has an expense ratio of just 0.03%.
Extremely low.
But SPY's expense ratio is over 3 times higher at 0.0945%. And the trading spreads for both are effectively 0.00% because they are so massive and heavily traded.
The cost efficiency is absolutely the primary anchor keeping retail capital locked in.
Right, because it's like choosing between 2 completely identical delivery trucks to move your life savings across the country. They take the exact same route and carry the exact same cargo, but one company charges you 3 times the toll fees to drive on the exact same highway. Obviously, you stick with Vanguard S&P 500 ETF. And people understand that over a 30-year retirement horizon, those tiny fractions of a percent aren't just pennies. Through the power of compound interest, that fee difference equates to tens of thousands of dollars remaining in their pockets instead of going to a fund manager.
Your delivery trick analogy perfectly captures the mechanical advantage of low expense ratios. It is undeniably smart math.
Thank you.
However, this raises a crucial question about the current psychology of the retail investor.
Uh-oh. Here comes the reality check.
Cool. Staying the course and ignoring the noise has historically been a very wise wealth-building strategy. But right now, the absolute blind devotion to the VOO and chill mantra might be lulling everyday investors into a dangerous sense of complacency.
Complacency.
Yes. They might be entirely ignoring the very real structural macroeconomic warnings that Vanguard's own institutional arm is currently publishing.
Wait, the institutional side of Vanguard is issuing warnings?
They are.
Because if the retail investors are happily chilling on the forums, we definitely need to look at whether Vanguard's own professional analysts actually agree with that relaxed stance for the rest of 2026.
They do not entirely agree with it, and that is the surprising twist in our analysis today.
Let's hear it.
Vanguard recently released their 2026 economic and market outlook, and it paints a very cautious, highly nuanced picture. On the positive side, Vanguard projects that the broader U.S. economy is fundamentally resilient.
Okay, that's good news.
They forecast it could hit a healthy 2.25% growth rate this year, largely supported by the massive economic stimulus of that $2.1 trillion in AI capital investment we broke down earlier.
Well, wait, if the overall economy is growing at a healthy 2.25% and corporations are spending trillions on new infrastructure, shouldn't that naturally translate to the stock market going up?
You would think so.
Yeah, how can the economy grow while the stock market struggles?
Because the economy and the stock market are not the same thing. The stock market is a forward-looking discounting mechanism.
Yeah.
The current prices of those top 10 tech stocks that completely dominate Vanguard S&P 500 ETF, VOO, are already priced for absolute perfection. They are priced as if the AI revolution will face zero roadblocks. Vanguard explicitly warns of quote-unquote stock market downside due to what they officially term AI exuberance.
Which brings us back to that dot-com fiber optic analogy from earlier.
Exactly.
The infrastructure gets built, it benefits the broader economy, but the specific companies that build it might not actually generate the astronomical profits that their current stock prices demand.
Precisely. And this is driven by a fundamental economic principle known as creative destruction.
Creative destruction sounds intense.
It is a concept popularized by the economist Joseph Schumpeter. Vanguard's analysts are heavily factoring this in.
How does it work?
Here is the mechanism. When every major tech giant commits hundreds of billions to building massive AI data centers, the total global supply of computing power skyrockets.
Makes sense.
But when supply skyrockets faster than enterprise demand, the prices these companies can charge their customers inevitably drop.
Ah, I see.
Their profit margins erode. The technology changes the world, that of the creation part. But the profit margins of the early pioneers are destroyed by relentless competition and oversupply.
So the consumer gets cheaper, better AI tools, but the massive tech companies footing the bill see their stock prices stagnate because they can't maintain their profit margins.
Exactly right.
And because Vanguard S&P 500 ETF, VOO, is 40% weighted toward those exact companies, the entire fund stagnates with them.
That is exactly the chain reaction Vanguard's models are predicting. In fact, Vanguard's internal projections suggest that U.S. large-cap tech growth stocks, the exact asset class that serves as the engine of Vanguard S&P 500 ETF, VOO, will likely only see a muted 4 to 5% annualized return over the next entire decade.
Wait, 4 to 5% over a decade?
Yes. They're explicitly stating that from a risk-return perspective right now, they actually favor high-quality fixed income like Treasury bonds and U.S. value stocks over the large-cap growth stocks that dominate the S&P 500.
Wait, so the very creators of the Vanguard S&P 500 ETF are essentially warning us that the heavily tech-weighted index, their own flagship fund tracks, might severely underperform historical averages over the next 10 years.
Yes, that is the stark reality their quantitative data is pointing toward. The era of effortless, double-digit annual returns driven by tech multiple expansion may be taking a long pause.
Right, but what does all that actually mean for Vanguard S&P 500 ETF VOO investors? If I am one of the 97% of people just sitting on my hands right now, how do I practically apply this warning to my financial life?
It means a mandatory and sobering adjustment of your long-term expectations.
So no more expecting 20% a year.
For Vanguard S&P 500 ETF VOO holders, the days of easily logging into your account and seeing a reliable 20 or 30% annual gain might be over for the foreseeable future. The underlying mathematical realities of the market are shifting.
It's a tough pill to swallow.
It is. We are entering a maturing AI investment cycle where companies can no longer just promise future innovation. They have to actually prove to Wall Street that they can extract sustainable, growing profits from these trillion-dollar data centers.
Show me the money, basically.
Exactly. Furthermore, we have to factor in sticky core inflation, which is currently hovering around a stubborn 2.5%.
And inflation acts like gravity on stock valuations, right?
Yes, it does.
Because when inflation is sticky, the Federal Reserve keeps interest rates relatively high. And when interest rates are high, the future earnings of these tech growth companies are mathematically worth less in today's dollars.
Exactly. Higher discount rates compress valuation multiples. It creates an environment where engineering a massive, broad market stock rally becomes significantly tougher.
Okay, so just temper expectations.
Right. Now, to be clear, Vanguard S&P 500 ETF, VOO, remains a stellar, exceptionally low-cost vehicle to own the American equity market. But investors need to deeply understand that passively owning the market over the next 10 years might only yield a 4 to 5% annualized return, not the 10 to 15% they have grown dangerously accustomed to over the last decade.
All right, let's bring all these threads together. We set out today to objectively assess if this fund is still the ultimate retail investment in 2026.
It is.
And here is the comprehensive summary. On the positive side, Vanguard S&P 500 ETF, VOO, remains an ultra-cheap, highly liquid, massive financial behemoth. You simply cannot beat that 0.03% expense ratio when it comes to keeping your wealth compounding over decades.
It is unmatched in that regard.
However, its heavy 40% reliance on just the top 10 tech stocks has really stripped away its traditional diversification, exposing it to severe sector volatility. This directly led to a Q1 2026 dip of negative 4.72%, as passive funds were forced to blindly absorb the shocks of new trade tariffs. And perhaps most critically, Vanguard's own institutional analysts are actively warning of muted 4 to 5% long-term returns for the exact large-cap tech assets that currently serve as the ETF's main engine.
Citing the margin-crushing realities of creative destruction? Yes.
Exactly.
That is an accurate, fully encompassing picture of the landscape. And I want to leave you, the listener, with a final, provocative thought to ponder as you review your own portfolio allocations this week.
Give it to us.
We know the AI scalers are heavily committed to spending $2.1 trillion to build out their physical infrastructure by 2027. But what happens if they fundamentally fail to monetize it at the scale Wall Street demands?
Oh, wow.
If everyday businesses and consumers push back on paying premium, escalating subscription fees for AI integration, and these tech giants cannot recoup those historic infrastructure costs, how insulated is your Vanguard S&P 500 ETF position from the subsequent tech sector fallout?
That's the big question.
When 40% of your entire retirement portfolio is mathematically tethered to the success of that specific trillion-dollar gamble, the comforting word diversification really does start to lose its meaning.
That is a very heavy and necessary question to consider, especially for everyone out there who has been happily chilling and assuming a rising tide will always lift their boat. The market mechanics have changed, and staying informed is your absolute best defense. All right, listeners, what's your take on the future of Vanguard S&P 500 ETF, VOO? Are you bullish, bearish, or sitting on the fence? Let us know in the comments. See you next time on the Byte-Size Brief.